in 30 seconds. All right. Good afternoon, everybody. Gary, do you hear me now? Can you hear me?
Yes, I can hear you clearly, Nick.
All right. Very good. Hi, everybody, and welcome to our webinar. In the next 45 minutes or so, we will be driving into the subject of corporate performance management, when it works, when it doesn't, and what to do if it isn't the right fit for your organization. We will explore challenges that companies face when implementing CPM and why some companies struggle or may struggle to see results and what can you do about it. And there's nobody better to guide us through this than my guest today, Gary Cokins, a leading expert in performance management. Thank you very much for joining, Gary. And why don't you give a little introduction about yourself?
Well, Nick, thanks again for inviting me to present. Yeah, just briefly, I'm 75 years old, but I feel like I'm 45 years. So my career is pretty much over. It's now a vocation. There's a difference. You all have careers, salary increases, job promotions, vocation. It's a calling. I'd like to make a difference. My undergraduate was in industrial engineering and operations research from Cornell University, 1971. Got my MBA from Northwestern University, Kellogg School of Management. My career began in industry for 10 years as a division controller for a conglomerate, then many years as a consultant, 7 years with Deloitte, 5 years with KPMG, 5 years with EDS, Electronic Data Systems, and then for 16 years, I was with SAS, SAS. People, what's SAS? Scandinavian Airlines? No, SAS is actually the world's largest privately owned software vendor, 15,000 employees, specializing in analytics. I retired from SAS 8 years ago. Now I just have fun teaching people, a little consulting projects from time to time, actually training other consultants how to implement the methods I'm going to be describing soon. Raised in Chicago, go Bears, those of you who are familiar with NFL football teams. And I now reside in Raleigh, North Carolina, which is where SAS is headed. Instead, I believe that I've written 10 books, I believe careers have a lot more to do with luck and circumstances than being smart and competent. I had a couple of lucky breaks. When I was 27 years old, I was a division controller in Milwaukee with this conglomerate, but I had the chance to become operations manager in the facility. And I used the phrase, I then had to eat the accounting data that I had been serving as the accountant upstairs. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external financial, statutory, regulatory agency accounting and internal management accounting. We'll talk about that during the interview.
Right. Thanks a lot for this introduction. I'm sure we could talk a lot about what you have done, your long and successful career. But let's start diving into the conversation a little bit. And before we start, I just wanted to give you a few housekeeping items. We have a chat. Whether you're watching us on LinkedIn or YouTube, please leave your comments. We will see them. And after the presentation, we will look at the questions and have a discussion. Now, really quickly, a couple words about us, about me. I am Nick Pavlov, a project manager at Sentida. We are a boutique firm specializing in management consulting, financial planning, and operations. And what makes us special is that we combine the business side of things and technical expertise in analytics. So with that, let's dive into what the CPM, EPM is, and let's start with the foundation that I wanted to say. So Gary, can you explain what exactly an enterprise performance management, EPM, and corporate performance management, CPM, are? Because for many people, I feel like the two terms they may mean the same thing, but how are they different?
Yeah. They are the same thing. It's just that when public sector government workers see some of the methods we'll be talking about, they see that corporate performance management, that it's not for me. So, but basically they're synonymous. Oh, by the way, I want to give my website because there's a lot of free articles in the below the tabs in my website. So if people listening want to write it down, it's www.garycokins.com, no punctuation. So yeah,
And I
EPM.
will put that in the chat so
Okay.
everybody can see that.
Yeah. EPM and CPM, think of them, they're the same thing.
Right. So they're the same thing basically. So it's either this or that. Okay. So understand that. Now over decades, right, we have seen companies investing in CPM solutions. And what's driving this interest? And are there any particular business challenges or trends that are making CPM more necessary?
Well, first, let me just give a kind of a simple definition of how I explain EPM. EPM, I say it's not a process or a system, it's the integration of multiple methods like management accounting, enterprise risk management, driver-based budgeting, rolling financial forecasts, strategy management with KPIs, and so on and so forth. So think of them like gears in a machine, and when you mesh them together, then they become very powerful. So I'm interpreting your question to be, what are the forces and pressures that have caused interest in corporate performance managed by organization? And I'm going to go through a list of 8. The first one is just executive frustration with strategy failure. Most executives are quite good at formulating strategy. Their frustration is failure to successfully implement it. And there's a fair bit of empirical evidence. There's a executive recruiting firm in Chicago that monitors the involuntary turnover of CEOs in North America. The firing of CEOs, it's been increasing every year. And I believe the reason why is board of directors post Enron. Those of you who remember the Enron collapse with Arthur Andersen, they take their job, their board of directors, far more seriously. So if the CEO is not implementing the strategy, they're fired. A good example, Carly Fiorini at Hewlett Packard. Second cause, increased accountability. Today, there is no place to hide. Managers and employee teams will be measured. They will be monitored. It doesn't necessarily mean their job is at risk, but it could adversely impact their salary increases and job promotions. Another one, 3, more rapid decision-making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today, managers, employees will be on the phone, go or no go, yes or no. They have to make that decision in real time. They almost wish that the CE executives were sitting next to them saying, what should I answer? 4, mistrust of the management accounting system for accuracy and transparency. And the issue here is most managers do not trust the management accounting system. Why? Overhead cost allocations. We'll talk about that, I think, a little bit later. It's typically really primitive. It's butter spreading. Oh, let's allocate the indirect overhead is really better referred to as indirect expense, which incidentally in most organizations is half of the expenses compared to the direct. And so the CFO and the accountants, they allocate it like on number of labor hours, number of units produced, number of sales dollars, and so forth. Totally flawed and misleading. Activity-based costing resolves this. Oh, incidentally, some of you, the people listening said, oh, he's going to be talking about manufacturing. No, activity-based costing and managed account applies to all organizations, service organizations, banks, insurance companies, and even public sector government. 5, poor customer value management. The issue here is that customers are the source of financial wealth creation for owners and shareholders. So you got to connect, if you will, actions with the customers to how it produces profits and wealth creation for the shareholders. But again, another problem, the CFOs are not helping. They're stopping halfway down on the income statement, reporting gross profit margin and loss or service. They're not including channel distribution expenses, marketing expenses, selling expenses, cost to serve, producing a profit and loss statement for each customer. And why is this relevant? Because the sales force needs to, and marketing needs to answer the question, which type of customer is more attractive to retain, to grow, to win back and acquire, which types are not. So they need customer profitability information. 6, contentious budgeting. This may surprise everybody. I think the annual budgeting process is broken. So my advice is stop budgeting. Well, did I get your attention? But that
Mhm.
begs the question, what was the purpose of a budget in the first place? And how can we replicate it using some of these enterprise corporate performance management methods? And if there's time, I'll try to explain a technique for that. 7, dysfunctional supply chain management. Now, this won't apply to everybody, Nick, because many of
Mhm.
some of the attendees are in retail business, so they're selling to consumers. But if you're in an organization that's in a, if you will, supply chain with trading partners upstream and downstream, the issue here is most customers view their suppliers as the enemy. It's an adversarial relationship. Oh, let's see if we can negotiate lower prices from our supplier. If we put them out of business, so what? We'll get another supplier. That behavior has to stop. It needs to be a marriage. So, trading
Mhm.
partners in the supply chain, are competing against other supply chains for a share of wallet or purse. So they really have to collaborate together to identify mutually beneficial projects. And finally, and I think this is a major cause of interest in CPM, is the unfulfilled return on investment promises from large ERP software vendors. So, for example, if you ask the chief information officer, IT director, you know, months
Mhm.
after you've gone through the long journey, a year or two of implementing the large ERP system, and I'll name some names, SAP, Infor, you ask them, how well do you believe the return on investment from what you've implemented has met or exceeded the ROI that the ERP software salesman sold you on 2 years ago? Many of them will be hard pressed to say, yes, we put in a lot of work and I'm not sure, we've got the ROI. That does not mean you don't implement the ERP. You have to remain competitive. But the issue is ERP systems produce a lot of data, but not information. And there's a difference between data and information. Data tends to be transactional, from procurement systems, payroll systems. You convert the data into information, and that's where you get the insights to make better decisions. So that's causes and forces uh, for interest in CPM. What other questions do you have for me, Nick?
Yeah, that's a lot and very interesting 7 factors that you just mentioned. So let's kind of shift gears a little bit and talk about barriers and implementation challenges. I mean, you briefly mentioned about ROI, right? So CPM, on the other hand, promises a lot, but rolling it out is not always as straightforward as one might think, right? So, in your experience, what are the biggest roadblocks that companies face when implementing CPM? And is resistance to change and company culture, like what are those some of these factors?
They're very relevant. It all starts, and I'm going to get in trouble with some of the audience. I think the CFOs and the accountants are in the 1970s. How do we get them into the 21st century to adopt these methods? And what you're really asking is, what is slowing the adoption rate of the various CPM methods? It does start with resistance to change. It's human nature. People like the status quo. Don't rock my boat. But other obstacles are fear of others knowing the truth. Oh, you're going to do activity-based costing? The other department and manager is going to know my cost. I don't want that to happen. Fear of being held accountable. Fear of being measured. Weak leadership. There, I said it. Not every company's executive team has the highest IQ. So notice none of those have anything to do with technology or software. It's all about people. So it's really required to overcome these obstacles and barriers is soft skills. The soft skills of behavioral change management. How do you get buy-in from the managers, and employees? And many CFOs and accountants just don't have those soft skills. Most of them I refer to as they're Newtonians. Nick, you even may be a Newtonian. The world's a big machine. Give me the levers, pulleys, dials. You need to be somewhat Darwinian, like Charles Darwin, not Newtonian, Isaac Newton, the physicist. So you need the soft skills.
Right. And when we talk about, the more of a technical standpoint, from the technical standpoint, right, where do you see companies struggling the most? Is it getting the data right? Is it configuring the software or managing the overall process? If we're strictly talking about the technical side of things now.
The technical is secondary. Most of it, I'm going to be redundant, so we can maybe go to the next question. It's really about the soft skills. It's about
Really? Okay.
behavioral management.
But is there like a certain level of a team, of a technical expertise that one needs to have, or it's secondary to the point where it doesn't kind of matter?
It matters, but it's just not, it's in my priorities, it would be lower down. And most organizations have technical people. They've got programmers, they've got an IT department, and even many CFOs and accountants, are fairly good with, Excel and pivot tables and all of that stuff. However, with activity-based costing is modeling. Costing is not key accounts and journal entries. So when you build an ABC model, you have to start with the resources, which is the general ledger expenses, salary, depreciation, phone, all that stuff, travel.
Right.
You convert them, you trace them to the work activities that are in the end-to-end processes. And then I like to use reassign the activities to the final cost objects, products, services, channels, customers. I don't like the word allocate. When people hear the word allocate, butter spreading, labor hours, number of units produced. So and many of the accountants have the understanding of that, but they're reluctant to basically implement. It's back to some of those barriers.
Thank you. Now, for those who manage to roll out successfully, right, what's the secret? Like, how do you get quick wins early on and keep building momentum and keep the leadership and team engaged?
I have a phrase: hitch your management accounting system to another wagon, or to a wagon. And what is that wagon? Key performance indicators, performance metrics. And that's where the Kaplan and Norton strategy map with its balanced scorecard comes into play. And there are other tools for strategy management, Hoshin, Conra, and OKRs and so forth. But I'm an advocate, because it's straightforward, of the Kaplan and Norton. That's Professor Robert S. Kaplan. Sidebar, incidentally, who I know quite well, because back in the 80s, I was recruited to KPMG when they struck an exclusive contract with Professor Kaplan to train consultants on activity-based costing. He didn't invent ABC. He researched it as a far superior way. But now I'm going to get it back to your question, hitch it to another wagon. If you start having the measurements, let's say for the sales force, profitability, not just on sales for their commission, but a blend of, let's say, 60% sales, 40% customer profit for each customer. So when the sales director has their account planning meetings with each, now that's a KPI, and it basically assures for that bonus or commission. And it can not just be salespeople, managers and employee teams also have some sort of incentive, motive. It assures that the ABC system will be recalculated at periodically intervals, quarterly, sometimes even monthly. So when I say hitch it to their wagon, it's that wagon assures that we will sustain and not abandon. Do a one and done. Oh, we did ABC once. We learned a lot, and that's it. We don't need it anymore. No, you want to refresh it periodically.
Right. Now let's change a little bit the gears here again, right? So I wanted to ask you about a series of questions: when, right, and why CPM may not be the best option, right? And first question is, obviously it's not a one size fits all solution, right? Some companies see massive benefits, others struggle to justify the investment, like we said. And how should an organization think about the trade-off between the value of CPM and the cost and time required to implement it?
I interpret your question as like, what's the ROI? What's the return on
Mm-hmm.
investment from putting in these CPM methods? And let's just use activity-based costing as an example. And when people ask me that question, I turn the table around and I say, well, first, you tell me what the ROI is on your general ledger, and we'll compare it to that. Obviously, it's a bit facetious. This, I know people are going to struggle with my answer because everybody wants an ROI, but somewhere along the line, faith, FAITH, comes into play. And once you see the evidence of with other companies that have put in activity-based costing compared to their traditional butter spreading, the magnitude of the error, it can be 30, 40, 50%. For example, a product that is $100 with the traditional overhead butter spreading with ABC, it's $140 or it's $30. It's really substantial magnitude. Now it's a zero-sum error game, but with that butter spreading of overhead, some of the products or service lines will be overcosted. The others must be undercosted because it's a zero-sum error game. Now,
Mm-hmm.
yes, okay, it reconciles in total. It satisfies the auditor. So when PwC or Deloitte or KPMG comes in, check mark, yeah, the inputs equal the outputs, satisfies the audit, but it's wrong in the parts. So that means the CFO is providing flawed and misleading information to their managers, and they're stuck with it. Remember, I said one of the forces and causes for CPM, I said,
Yeah.
was most managers do not trust the management accounting system. And when they think of that overhead, God, their eyeballs roll. Like, so it's so some companies, some managers have their own little side system. They have their own little parallel accounting system because the CFO and the accountants aren't providing them what they need.
Yeah, the shadow IT, right? It's called. Yeah.
Shadow. Yes.
Mm-hmm. Now, what are the biggest risks you think for companies that pass on implementing a comprehensive, EPM, CPM solution altogether? Like, what if they don't decide to do it, to implement CPM?
I think the biggest risk is they're missing the opportunity to substantially improve their financial performance. So, for example, when you really know using activity-based costs, which products are more or less
Mm-hmm.
profitable, you can make different decisions. And if they're really unprofitable, you have to start thinking, well, maybe we should abandon, this product, or maybe we should just stop. We'll stop selling it and let our competitors sell it and let them lose money on it. Another,
Mm-hmm.
management accounting also provides good expense and cost information to start focusing in on where are some of the opportunities, cycle time reduction, quality removal. ABC can be integrated with lean accounting. I'm bringing in a term that many may not have are not familiar with. It's from the lean management community. And what lean accounting does is it takes these activities. Remember, ABC is resource expenses ledger into the
Mm-hmm.
work activities. That's in a dictionary reassigned to the products and services. But you can take the activities in the middle and string them like pearls in a necklace horizontally. And that produces what are called value stream maps or process flow diagrams. Now, so the operations people, when it comes to the profitability, they may say, well, that's not our job. I just hope they're figuring out what the profits. But my job, our work is cycle time reduction, quality improvement, and so forth. And then they can tag these activity costs, like value added, non-value added, or other, we call these attributes that can be tagged. Commercial ABC software allows this tagging of the activity costs, like the color of money,
Mm-hmm.
So So another missed opportunity, in addition to cost reduction, is back to the customer profitability. It's a missed opportunity to not know which customers are more or less profitable. And as I use the example, for some customers that are very unprofitable, you can, we call it fire the customer, terminate it, the relationship, let someone else. But you can also take the existing situation and say, well, how do I increase the profitability of each customer? Cross-selling, upselling, what we call fee-based, charge them extra, because here's another thing. There are what we call angel customers and demon customers. What's the difference? Demon customers, high maintenance customers, always changing delivery schedule, always calling help desk, always returning goods. The angel customers, we love them. Never change delivery schedule, only buy standard product, never call help desk, never return goods. If those two polar opposite type of customers purchase the same volume, same mix, same price, they're not equally profitable, because the high demanding demon customers are causing so much, extra expense. So when you have the facts and the visibility, then you can say, well, what actions can we take to lift them up? I was using fee-based. If they're doing all this extra work, charge them a fee. Look at the airlines have been charging for baggage, or if you want to move from a middle seat to an aisle seat, you got to pay extra. Banks charge extra for depository accounts. So I hope that answers your question of what are you were saying, what's the risks? I'm saying the risk is missed opportunity for
Missed
higher
opportunities.
growth.
Makes sense. Yeah, the more information, right? Obviously, you're missing out on some of the more important information and data, right? Sorry, data and information. Now, what if, say, a company doesn't have a CPM for whatever reason, right? So let's talk about alternatives to traditional CPMs. So let's say a company doesn't have a CPM. Now, how can businesses then integrate methods such as activity-based costing or rolling forecast without a major software overhaul? So without
Yeah.
CPM.
For me to answer that question, I need to preface it a little bit about ways to effectively and quickly implement these methods. And then I'll get to the integration issue that you're talking about. And I probably should have mentioned this as one of the barriers of these methods, because a lot of people think, oh, it's too complex, it's too costly, it'll take us 6 months, we don't have time, it isn't worth the effort, kind of like the ROI is not there. I have been implementing activity-based costing for clients and training other firms in 3 weeks. And the way I do it is called with rapid prototyping with iterations. It starts with a 1-day workshop with 5 or 6 cross-functional employees in a room. We build and construct a high-level ABC model. I give them about 6 commercial software vendors that do it. I say, you choose them. They don't have to purchase the software. That keeps me software vendor independent, and I don't get any referral fees from them. And we construct the model, the resources, the activity dictionary, all the way to products and services. So the morning of the second day, now we bring in their other line managers and the senior executives. They see what was constructed, very engaging, because it's their own company, not some sort of Harvard Business School, ABC case study. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading of overhead. Oh, that's how we can see profit margins by layers, like an onion skin, because for each activity, if you got 30 activities, you actually got 30 layers of profit margin, which you can do comparative analysis with other customers. Oh, that's how we can see which customers are more or less profitable. Oh, that's how we can do benchmarking with apples and apples, not apples, and oranges, kind of thing. So, and let me briefly talk about the strategy map. Same thing can be done. Oh, back to the ABC. After that, then I work with the modeler who's familiar with the software. They stay for another week or two. They do a couple of iterations. They start decomposing some of the activities. Also, with the rapid on day one, it's all with percentages: 30, 30, 40, 10, 10, 80. In any cost allocation assignment system, everything normalizes to 100%. So that can basically just done with their familiarity. Oh, 30, 40, they get the idea. In the next iteration or two, we start replacing some of those percentages with transactional information, like from the ERP system. And so it's good enough. Strategy map. My technique for that, because a lot of them, I read Kaplan and Norton's strategy map, and balanced scorecard. And notice I call it its balanced scorecard. This may surprise people. They claim, we've got a balanced scorecard with KPIs. Do you have a strategy map? No. Strategy map to me is 20 times more important than the balanced scorecard. The balanced scorecard is a feedback mechanism. The real intelligence is in the strategy map, but there's not enough time for me to do a lecture here. So those of you who are listening to me, just do an internet search on strategy map and get a little familiar with it. But again, they think, it'll take 6 months to enter. The technique I use is I have all the executives fill out the night before 20 yellow Post-its, with strength, weaknesses, opportunities, and threats. Many of you are familiar with SWOT analysis. That's what SW is. So they have the 20 filled out, come into the room, and I do have to describe the strategy map. Across horizontally, there are what are called the 4 perspectives: learning and growth and innovation, which leads to customer process perspective, leads to customer perspective, leads to financial perspective. Go to the wall and put your yellow Post-its under one of those 4, straightforward. Now I say, go back to the wall. Do not talk to each other because they get excited. Look at the other yellow Post-its the other people put up and move them tangented to similar ones. And guess what, Nick? 30 minutes later, there's 2 to 3 clusters of these yellow Post-its under the 4 perspectives. And those are what are called strategic objectives. That's 10 o'clock in the morning. So we name each of those clusters. Then the rest of the day is the next 2 steps. What project or initiative will accomplish the strategic objective, or in some cases, a core process we have to get better at. And once we have those, what would be a metric that we could monitor the progress of accomplishing those strategic objectives? I'm going to repeat that because this is the definition of a key performance indicator. Its purpose: monitoring the progress of accomplishing the strategic objectives. And the executive will put targets on those KPIs. So now you start holding different managers accountable for different KPIs. We've aligned the behavior and priorities of the manager and employees with the strategy. And now we get back to that problem of the executives being fired because they're not implementing the strategy. One other thing, Nick, another reason that there's 2 reasons Kaplan and Norton created the strategy. One, they observed that executives were overreacting to financial results reported at the end of the fiscal period. They said, you need to shift your attention to non-financial metrics measured during the period so you can react to them. So things like cycle time and customer satisfaction. But another reason they created it is because most managers and employees do not understand the executive team strategy. I mean, for example, if I went into one of your Santita's clients or anyone listening to me, I went into your company, and in the hallway, I randomly interviewed 10 employees and said, quick, 2 minutes, I'll write it down. Can you articulate your senior executive team strategy to me? How many of them could do it or do it well? Maybe none. Well, if the employees and managers don't understand the strategy of the executive, how do we expect them to understand what they do each week contributes to the strategy? So this strategy map methodology communicates the strategy in a simple way to managers in a way that they can understand it. So I'm not sure, did I end my, this is long to your story about integration. Some people will say, well, we have a large ERP vendor. I'm not going to name names, but all of you can plug in any. And the module for ABC is really expensive. All their modules are expensive. So what I have done with them several times is we go back to these 5 or 6 commercial ABC software vendors that they select. We do the rapid prototyping with the iteration. So in 3 weeks, they've got a permanent, repeatable production system, which means they can refresh it periodically, quarterly, ideally monthly. But the IT director is going to come in and said, well, our IT policy is we must use our ERP system to do this stuff. And, you've brought in this commercial little, tiny, what I call a shiny toy. And the commercial ABC software is a fraction of the ERP. And then what we'll do is migrate. We will eventually abandon the commercial ABC software. It served the ROI was already there, but we've accomplished the data requirements definition for the ERP system. If you're familiar, this is an IT talk, data requirements, definition. So all of the accounts from the ledger have been identified, the activities constructed, and so forth. And so now it's much simpler to implement and install the ERP vendor's activity-based costing module. And it also becomes kind of like a closed loop, because when you've done the ABC, let's say for product costing, so let's say the company's got 1,000 product. Well, now we've got 1,000, what's called standard cost, but it's not with the overhead butter spreading. So now we got the standard cost that can be exported back into the ERP tool for the inventory, balance sheet information. So effectively, you started with the ERP tool, you extracted the ledger, the expense information, the ABC becomes a calculation engine. It's done. It puts it back into the ERP tool. And I'm not sure I'm answering your question, but you kind of like say, how do you integrate these? I'm a big advocate. Use the commercial ABC, but at some point, especially if the IT director insists we must use the module, we've already done, not only have we done the heavy lifting, but the managers have gotten comfortable getting insights, interpreting it, because it's really common sense, ABC. They're already making better decisions. So now we put it into the ERP tool and we can continue the journey.
Thanks. I apologize. I tried muting myself. It's not a gun violence if you heard anything outside. I live in Spain, Valencia, and we're having this festival of fireworks where every single day for 3 weeks, we're having just fireworks everywhere. So if you heard that, I apologize. With that, we have, I just wanted to really have 2 more questions, and maybe you can put that into one. So I read in your, articles that you wrote about the hybrid approach, right? You kind of mentioned a little bit about it, where you would maybe deploy partial or niche solutions, but then still manage to have strong results of an EPM. And then can we tie that with emerging role of new technologies? I mean, everybody talks about AI and advanced analytics. What kind of role do they play in providing, or possibly can they provide an alternative to traditional CPM?
Oh, I don't think it's a replacement. And I don't have expertise with artificial intelligence and robotic process automation, RPA, which is sort of associated with it. I think everybody's reading about it and wondering, is this going to be a minor impact or is this a game changer? Some people have said this is going to be as big as the internet, which is pretty big match. I'm learning too. And one of the thoughts I want to start talking to other consultants and AI people is maybe AI can create the activity dictionary, back to the ABC, by somehow looking at whatever organization chart, whatever information that AI can do, and create this activity dictionary. Typical ABC system has 60 to 70 activities. Verb, adjective, noun, process, invoice, move materials, But if people who are listening to me, and I'm gonna advocate a consultant that I've learned in the past. Um, I see something. Did you put this on the screen?
Oops. Yes, I apologize. I There was a question coming in.
Oh, okay.
Yeah, I'll put that later.
Yeah. Hey,
So
hang
go
on.
on, please.
The name, he's in Germany, Stuttgart, Germany. His name is Nicholas Boucher. I will spell it Nicolas. His last name is Boucher, Boucher. And he's created what he calls the AI Finance Club. 3 words, AI Finance Club. Maybe just do a search on AI Finance Club, and he's really now describing different ways that the CFO, finance and accounting function, can leverage artificial intelligence. So I'm kind of handing off the answer to you, to Nicholas. He's a good guy, and they can learn more from him. So
Perfect.
I think
We've been, yeah. Sort of, go on.
we're near
Apologize.
the end of your question. So what do we do?
Yes, we are. Well, it's been 40 minutes. We have a few questions, and what I will do is I will put them on the screen. You can read that, right? Ilya is asking,
Well,
what's the best? Yeah,
I'll read it. What's the best strategy seen for overcoming resistance to CPM implementations from stakeholders within the finance function and broader business? The technique I've used is, and this is one of these behavioral change management, is a formula. Think of it as a formula. I'm going to give it, you may want to write it down. D times V times F is greater than R. Okay. So because D times V is F, if D, V, or F, I'll tell you what they are zero or very small, they're not going to overcome R, which is resistance on the right side. And do not underestimate the magnitude of resistance. It's big. Okay, so you're asking Gary, what's D, V, and F? D is discomfort with the current state. Unless people have dissatisfaction or some sort of pain, they're not interested in changing. V stands for a vision of what better looks like, a solution. And so if you've got big D, you've got real discomfort and pain, you're looking for the lifeboat, the V. And you would think, well, if I got big pain and I've got V solutions, and that's the corporate performance management solutions. We didn't talk about driver-based budgeting, but it's in my website, but that can be done too. But all these methods, you'd think you're overcoming the resistance. F is a sleeper. F stands for first practical steps, because if they think your solution, the CPM, the activity-based costing, is overly complicated, overly expensive, unaffordable, theoretical, they're not going to go ahead. So to put this in the context, answer your question, Ilya, the F is rapid prototyping. Do the, crawl, walk, run, fly, soar, fast, start small, think big. But in 2 to 3 weeks, get them to buy in. But where you really need to go is to the D side. And I'll tell you something personal in my career. When I was younger, I'll be candid. I think I was a little cocky, I got a Ivy League industrial engineering degree. And I always like to say I'm an engineer masquerading as an accountant. I've been, but, it's like show off what I know. No, the way to go is ask questions. So go to the management. Do we know where we make or lose money? Are we satisfied with our allocation method? Strategy map. Are we measuring the right things? Do we know which customers are more or less profitable? Notice those questions are all designed to create a little discomfort, especially if you ask them of the executive team. Now, it could be career limiting, so you got to be careful. You don't want to get fired because this person's probing too deeply. But you need discomfort as the starting point, and that will then lead to what will mitigate the pain. And then comes, well, how do we do that? Oh, well, there's fast ways to get this in. So, Ilya, long answer to how to overcome resistance. It's the formula D times V times F is greater than R.
Right. Well, here's a comment. Yeah. Another user
That was
has
a Chicago, and go Cats,
yeah.
go Wildcats, Northwestern, go Chicago Bears.
Go
All right.
Cats. This is a long question. Let me see that from the whole, because I don't see the entire question here. Let me put it in the chat. Um, I'll put it in here and then try to read it the whole thing, okay? Because it's a long.
I'll read it. I have a technical question. Is the consolidation tool a part of CPM? Not only IFRS reporting needs intercompany eliminations, but also budgets for when it comes to large corporations. Really, I'll just try to answer it. You can remove the question. When you're doing consolidations, that's going to come from your business software. And my advice is have two separate systems. Have the ABC management accounting system for managers. In fact, here's an anecdote. I did an implementation for a large food company in Seattle, Washington. And when we implemented ABC, what the CFO wrote to all the managers is, as of today, nobody is going to use our general ledger accounting system except we as the accountants. We will close the books, do all the consolidations, all the stuff that was being asked that question for our regulatory agencies, SEC in the United States, Deloitte, KPMG. Everybody else will only use the ABC information. So I'm trying to answer their question that you still do the consolidations. You can still do all of it the old bad way. It's flawed and misleading. Shareholders aren't making decisions on products. They're not even seeing line of business. They're saying line of business, very grouped. But the management accounting is used internally, not externally, for decision making. That's my answer.
Okay, that's a. We kind of talked about it, right? We have quite a few questions from YouTube, but we're also kind of almost out of time. Gary, as we talked about before, right? I will gather all the questions that remain, and then I will email them to you. And within 24 hours, right, we will get back with answers to
Yeah,
those.
it may be 48 hours, but
48 hours, yeah.
Nick, let me just have a concluding remark.
Mm-hmm.
I believe in the past, the best leaders and best executives had the best answers. Today, I do not think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much volatility, there's too much uncertainty for them to rely on their intuition or gut feel, or the types of decisions they made in the past that got them promoted to the top. They need to create a culture of investigation and discovery and tolerance for making mistakes, as long as you learn from your mistakes. So that's my message about leadership.
Leadership, yeah.
Thank you,
And
Nick,
that's
for inviting me to be a presenter.
thank you for being here. That was very, very interesting and knowledgeable, and I'm learning a lot. I feel like there's a lot of gap that I have to now, read on and understand half of what you're saying. It's my pleasure to even speaking with you. Now, if one my question, personal question, last question is if you were to look at, if you had a crystal ball, and if we're trying to look at where are we moving from now into the future, let's say 5-10 years from now, how do you see this field shifting? I
Inter-
mean, we don't know, but what, in from your experience, what do you think it could be?
Integration. I said in the beginning, way at the first couple minutes when I defined corporate performance, I said it's really the integration of multiple methods. Well, many companies right now, if you look at their methods as the gears in a machine, some of the gears are disengaged, so they're not connected. Some of the teeth are broken, in the
Right.
gears. Someone threw sand into that. So imagine these gears, the various multiple methods, strategy map, ABC, and so forth, are in your automobile engine, well, it'll run, but your fuel efficiency will be very low. So my crystal ball is people are going to first put in the gears, and they're going to mesh them so that they're tightly integrated. They're going to put lubrication in there, oil, digitization.
Mm-hmm.
And now the gears are going to be spinning much more quicker, better, faster, cheaper, smarter, safer risk management. And now put that metaphor analogy into your automobile. And what's your fuel efficiency? Much higher. Now replace the metaphor of fuel efficiency in a car with rate of shareholder and owner wealth creation. That's how all of this will fit together. That's my crystal ball 5 years from now.
Right, right. So for a young professional like myself, for example, which one thing do you think would you suggest to get really good at?
Oh golly, people are probably picking up that Gary really loves activity-based costing. And I do, because it just empowers those managers who really deserve, better information. But Nick, I actually might go to the soft skills, learn more about people, change management, getting buy-in, understanding cultures, learning how to ask good questions, stimulating questions, and the like. You're going to need those capabilities and competencies the rest of your career.
Understood. Thank you very much. It was a pleasure. Still digesting everything you said, and appreciate you being here. Hopefully we can speak another time in the future, and with the questions, we will definitely get back to everybody.
Well, as a reminder, in my website, Gary Cokins, below the horizontal tabs are dozens of articles I've written, all free. You don't have to purchase anything.
Go there, read. There's a lot of information on Gary's website. All right, Gary, thank you very much. You have a great rest of the day. For those of you in Europe, have a good evening, and I will talk to you later. And I am